Building a modern corporate enterprise requires massive upfront commitments of capital. To construct the physical assets, hire the workforce, and scale the operations, a business must secure funds far beyond its initial revenue. As illustrated in this flow of funds diagram, a business acting as a deficit income must tap into financial markets. Here, the company absorbs surplus capital from households and other investors, channeling idle resources into active corporate growth. Companies extract this capital by issuing two mutually exclusive types of securities. They can borrow money by issuing debt, or they can sell fractional ownership by issuing equity. These instruments grant investors entirely different rights. Lenders holding debt have a rigid, priomatized contractual claim, guaranteeing the return of their principal with fixed interest. Equity owners, by contrast, hold a perpetual, residual claim on the company's future profits, absorbing the maximum risk in exchange for infinite potential upside. Because the legal and structural nature of these claims sit on opposite ends of the spectrum, analyzing them requires two distinct frameworks. The metrics used to evaluate the value, risk, and return of debt are entirely incompatible with those used for equity. To evaluate either security, we have to start at their absolute nominal origin, the face value or par value. On the equity side, face value is strictly the nominal price of the share capital initially issued by the firm. It is a static, historical accounting figure. On the debt side, face value represents the actual loan principal. This is the exact amount of money the company is contractually obligated to repay to the lender at maturity. From this starting point, the equity side of the ledger begins to evolve over the life of the business, leading us to book value. As a company operates and generates profits, it retains some of those earnings. By adding these retained earnings and accumulated reserves on top of the original equity face value, we arrive at the book value per share. Book value represents the theoretical, accounting-based realizable value of the company's net assets. If the firm ceased operations today and settled all its liabilities, this is the value that would theoretically remain for the equity shareholders. Accounting metrics provide a historical baseline, but securities do not trade on balance sheets. They trade in active secondary markets. Here, the rigid book value is replaced by the market value. The price of a share fluctuates continuously based on external investor sentiment, liquidity constraints, and shifting expectations of the company's future performance. Beneath that fluctuating market price lies the intrinsic value. This is the calculated present value of all the free cash flows a business is expected to generate over its remaining life. It represents what the underlying business is actually worth. The core task of equity research is identifying discrepancies between these two numbers. If an analyst determines that a company's intrinsic value is greater than its current market value, the security is undervalued, creating an opportunity to buy. When we multiply the current market price of a single share by the total number of outstanding shares, we calculate the market capitalization. This is the collective value the market places on the firm's entire equity. But market capitalization only tells the equity story. To measure the true cost of acquiring the entire business, an analyst calculates enterprise value. We start by taking the market value of the equity and adding the market value of the company's outstanding debt. The final step is to subtract the company's cash and cash equivalents from that total sum. We subtract cash because it is an idle asset. It is not gainfully employed in the core operations of the business. An acquirer would simply use the target company's own cash to immediately pay down a portion of the purchase price. By accounting for both equity and debt while stripping away idle assets, enterprise value reveals the true economic cost of a takeover. It allows an analyst to evaluate a firm's core operating performance without the distortions created by its specific capital structure. Once the value of the firm is established, an analyst must measure the returns it generates for its investors. On the equity track, returns depend entirely on residual profitability. The foundational metric here is earnings per share, or EPS. This is calculated by taking the company's net profit and dividing it equally among the total number of outstanding shares. It is important to distinguish EPS from dividend per share. A company rarely distributes its entire profit to shareholders. Dividend per share is strictly the specific fraction of the EPS that management chooses to pay out as cash, retaining the rest for future expansion. To contextualize these earnings, we use the price-to-earnings, or PE ratio. We calculate this by dividing the current market price of the stock by its earnings per share. There are structural exceptions that alter this equation. For instance, companies sometimes issue shares with differential voting rights. In these cases, investors accept inferior voting control over the company, specifically in exchange for higher dividend payouts. Ultimately, the PE ratio serves as a precise gauge of market sentiment. It measures exactly how much capital the market is willing to commit today in order to own one single rupee of the company's future earnings. On the deck track, the analytical lens shifts completely. Lenders do not care about EPS growth or dividend payout ratios. They care about borrower survival and the strict fulfillment of a contract. A debt contract rests on three structural pillars: the principal, the face value of the loan, the maturity, the exact date the loan must be repaid, and the coupon, the fixed interest rate paid to the investor at regular intervals. The most basic way to measure a bond's return is the current yield. This is simply the annual coupon payment divided by the bond's current fluctuating market price. However, professional debt analysts require a far more comprehensive metric: yield to maturity. Looking at this spreadsheet calculation, yield to maturity functions like an internal rate of return. It is the exact discount rate that equates the present value of all future cash flows, both the periodic coupons and the final principal redemption, back to the bond's current market price. Yield to maturity relies on a strict mathematical assumption. It only reflects the investor's actual return if the bond is held all the way to its maturity date, and if every single coupon payment is reinvested at that exact same YTM rate. If an investor sells the bond before maturity, they must calculate the realized yield, or holding period return. This metric accounts for the actual capital gains or losses realized by selling the bond at a different market price than it was purchased for. Where equity analysts evaluate an infinite horizon of potential business growth, debt analysts map strict, finite cash flow schedules to protect fixed returns from erosion. Beyond the risk of a borrower defaulting, a fixed income investor must navigate a primary market risk: macroeconomic fluctuations in interest rates. The strict mathematical rule of debt markets dictates an inverse relationship. If prevailing market interest rates rise, the price of existing bonds must fall to remain competitive. To measure this risk, analysts calculate duration. Duration is the weighted average time it takes for an investor to receive their original investment back through the bond's cash flows. By adjusting this formula, we get modified duration. This is the exact metric of price sensitivity. It tells the analyst precisely how violently a bond's price will swing in response to a 1% change in interest rates. Duration operates on fixed structural rules. Bonds with longer maturities, or those paying lower coupons, inherently possess higher duration. This means they carry significantly higher interest rate risk. Modified duration allows debt investors to mathematically quantify their exposure to macroeconomic shocks. It is a risk metric entirely disconnected from the day-to-day profitability of the company issuing the bond. A corporation is a single entity, but it is financed by two distinct pools of capital. On one side are the equity owners, on the other, the debt lenders. Equity investors chase intrinsic value and track PE multiples to capture infinite upside. Debt lenders rely on yield to maturity and monitor modified duration to survive finite term limits and interest rate volatility. Mastering both of these distinct terminologies is a requirement for any research analyst. It is the only way to successfully bridge the gap between a company's static accounting data and its dynamic valuation in the financial markets.